You're watching Morning Brief at 9 right here on News 9. Let's bring you all the action from the stock markets as they just opened a few minutes ago. Well, it seems to be a negative start for markets this morning. Some sort of choppiness and correction mode quite visible in trade in the early first few minutes at least of the morning market open action. Let's look at the charts. The Nifty 50 and Sensex are both in the red this morning. Nifty 50 racing below that 25,000 level. Sensex, meanwhile, holding comfortably above the 81,600 odd levels. Let's look at the Nifty 50 heat map and try and see which are the sectors which are reeling under some sort of pressure this morning. It seems to be the energy stocks. Reliance Industry is down about 0.6% or so. ONGC down about 0.3 of a percentage point this morning. Pain also visible continuously on the IT sector. You've got HCL Tech down about almost 0.75 of a percentage point. Infosys also more or less flat, but TCS down about 0.4% or so this morning. The banking sector also reeling under some pressure. ICICI Bank is down almost 0.8% in early trade. Meanwhile, HDFC Bank is down about 0.5 percentage point or so. Bharti Airtel, which had seen 2 days of consecutive rise, is more or less flat this morning. Nothing new really in terms of investor action. But what should you, the retail investors, read into these charts and this choppiness that we are seeing last few days in the markets? Mohit Gang is here to run us through what he's making of it and what he would expect you to do it. Mohit, good morning. Thank you so much for your time this morning and help us understand from a retail investor perspective, this little bit of up, little bit of down, massive rises, massive corrections on particular days. How should retail investors read these charts?
Hi, Kartik. Morning. Always a pleasure to be on your show. Look, I think the world has become far more unpredictable than what you and I can possibly think and debate about. I
Okay.
think geopolitically, the situation changes overnight. Every day, there is a new reality which dawns upon us. Right. So there is a peace talk, so-called peace talk between Trump and Putin. And again, morning you wake up and you figure out that there has been heavy bombing and there is a fresh wave of attacks on Ukraine. So it's very unpredictable. From a retail investor perspective, it's actually extremely difficult, not just from a retail investor perspective, from any investor perspective. It's very difficult to track all these events and to make sense out of it, right? So no one would have thought that China would perhaps issue statements in favor of India, right? So these are all new geopolitical realities which are dawning upon us. So my sense is for a retail investor, you don't have to jump in with every rally in the market. You don't have to redeem with every correction in the market. You have to just patiently bide out time. And I repeat, you have to just patiently wait for the opportune time to come and knock upon us. Look, on a valuation side, there is no doubt that India is quoting at a very higher band of valuations. There is no earnings growth, and you have the tariffs and trade tantrums which are coming upon us. So there are a lot of headwinds which we have to face, right? So my sense is you have to just gradually keep dipping up your toes in the choppy waters, not be completely out of it. You cannot be out of it because one single piece of news can completely change the morning when you wake up, completely change the markets, right? So you have to keep dipping in your toes, but not completely try and measure the depth of flowing water with both your feet. So that's the only thing which I can say.
So what should be the strategy at this point, Mohit, when you wake up to this uncertainty every morning and this choppiness every morning, not knowing which direction the market is going to move the next day because God alone knows what Trump is going to announce at night after Indian markets have closed. What should be the strategy? Just stay invested in your mutual funds, SIPs, so that you get a basket of stocks which sort of overall manages the volatility which emerge from specific sectors or specific stocks. Should you go for index-based investing, passive investing, or should you be picky about the sectors where you should put your money at a point like this?
Look, I would still go with a classic way on this one, which is investing in a diversified basket of mutual funds, going
Okay.
with your time-tested large caps and flexi caps, more towards the safer side of or more towards the conservative side of the horizon, basically, and keep doing your regular monthly allocations. Look, you cannot stop your monthly SIPs, STPs, which are going on because that's your accumulation strategy. Whether it will create wealth or whether it will create returns for you in a year or so is a debatable topic, but it definitely will help you accumulate a corpus, which at a later point in time, perhaps 3 years, 5 years down the line, will create significant amount of returns or value for you, right? So that's the ploy one has to take. Keep
Right.
doing your SIPs, and be safe in mutual funds. Don't try and take sectoral funds, because sectors also are changing very, very dramatically, very frequently, right? So if
Right.
there is a high tariff on a particular sector, you might not know which way the fortunes swing. So better to be in a diversified flexi cap kind of a theme, where
Right.
the fund manager is actually executing the calls on sectors and market caps on investors' behalf, and
Right.
just play a little conservative right now.
Right. So, of course, you mentioned those who have a slightly longer time horizon, 3 years, 4 years, 5 years. But those who have a shorter time horizon at this point, Mohit, should they be dabbling into markets at all, or should they look at other tools available, like perhaps mutual fund? I beg your pardon, like perhaps fixed deposits. But again, at a time when RBI has cut rates, those options don't seem as lucrative as they did perhaps more than a year back.
Anything which is any pot of money which is less than 3 years, Karthik, has to be very cautiously deployed in. I would refrain from putting that pot of money into equities. At best, you can take a hybrid call if the pot is greater than, let's say, 2 years, or it's between 2 to 5 years kind of money. Then you can take a hybrid call. Again, depending on your time tenor, you can take a conservative hybrid approach, or you can take a slightly aggressive or a balanced advantage kind of an approach. Right. From a fixed deposit perspective, yes, you are right. The rates will keep coming down. Having said which, I think at any point in time, the rates just reflect what the overall inflation scenario in the economy is, and what should be your outlook for a safe rate of return from the economy, right? So
Right.
even the returns on the liquid funds and the shorter duration debt funds will keep coming down from a YTM perspective, but that's the reality. So you can't do away with it. So my sense is, for people who want to play within a year, kind of a band, they have to keep at the shorter end of debt funds. People who want to play between 1 to 2 years perhaps can go into categories like equity savings or arbitrage, or these kind of categories. And from 2 to 4 year kind of a perspective, you can start getting into hybrid funds, but nothing in equity for a shorter tenor.
All right. And what's your view on gold with the festive season around the corner? Demand likely to increase despite the prices, gold hovering around the 1 lakh rupees per 10 grams mark. Is this the time to start accumulating at least a little bit in the run up to the festive season? And that is when you could perhaps look at cashing out.
It's a very tricky call, Karthik. To be very honest, I think
Yeah.
gold has run up a lot.
Yeah.
Honestly, to go all out and give a buy call at these levels is very difficult, even for a braveheart or a diehard gold fan like me.
Yeah.
I would not do that, honestly. I think though gold as an allocation in your portfolio, a 5 to 10 or 10 to 15% is always a must have. So there is absolutely no doubt you should continue to have that allocation. But would you go all out and buy it accumulated right now? I would rather not.